Hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 9th, 2020. And to all of our clients, friends, and family out there, the Blanke Schein Wealth Management family, we're a family practice, 3 generations within the industry here to serve our clients. But yesterday, we had a very special day. On June 8th, we welcomed a new addition. Not me, not my news to personally share. I became an uncle for the first time yesterday. Rick Jr., as we refer to him, as you know him, he is William Frederick Blanke the Fifth. He just had his first son. He's the third child in his household, two daughters, and now he just welcomed William Blanke, Frederick Blanke the Sixth. So again, we got Rick Sr., Rick Jr., now we got Little Ricky, as we're referring to him on an ongoing basis. But I'm a uncle. They call me Uncle Bob, and I have 7 nieces, including all the family around, and 1 nephew. So it's really exciting. It's just something that we're really excited. Mommy and baby and everyone in the Blanke family are really they're all happy and healthy, and the baby is doing extremely well. So we'll share some photos when his time is right. But just want to make that announcement, and to all of our clients that are out there and friends and family. Our first topic today: expect volatility to present itself both on the short and long-term basis once again. In fact, we just saw since mid-March, the last 50-day trading days, if you will, the largest snapback that we've ever seen in terms of market. In fact, it's in the equity markets, it's a V-shape, and it's a very historic in nature. The breadth internally is very positive. The advanced decline lines, meaning those that are making new highs versus those making new lows, is very strong. It's very positive. A lot of the internals of the market themselves are very positive. But as I mentioned back in March and April on my daily updates for clients, what we could expect, I use the analogy like a rubber band. So as much as the rubber band snap back, or pull down and stretch, the stronger the stretch, they're going to snap back just as hard as they came down. Ultimately, if it's truly going to be a V-shaped recovery. In fact, that analogy turned out to be true. In fact, we're seeing that right now. But much like that, then you get to the point where markets sort of get tired, and that tiredness is not a bad thing. As I mentioned, the internals of the market are very, very, very positive. So long-term bullish, short-term tired. Therefore, the volatility could start picking up. That would not be uncommon. That would not be unexpected. So let's keep an eye out for that. But ultimately, the long-term is bullish. But short-term, I could see sort of this rally taking a breath. So I just talked about volatility could creep back in, but there's a lot of internal strength within the market. It's building within the market. So short-term, we could see a breather in the equity markets in the month of June, closer to the month end maybe. But long-term, it's very bullish. In fact, there's research that we read this morning that basically went back in data sets. And anytime we had the economy report unemployment declining for 6 weeks consecutively, think 1980, 1982, back in the 70s and a few other times. Right before then, right after, you have, just like we've concluded, we just in fact concluded a 6-week decline in unemployment rate. So meaning it's going down. And employment is rising. That indicates on a go-forward basis in the markets, historically speaking. Of course, this could be different this time, like it always is. That's my little disclaimer. But historically speaking, going back the last 50, 60 years in the markets, it sets up another bull market, and pretty strong, if you will. So we will wait and see. But the internals of the market are very strong. And so we don't expect anything less at the long-term effect. If you're a long-term sort of buy and hold investor, this is sort of a good spot for us on a go-forward basis. So let's keep an eye on that. And finally, just interest rates. The interest rate setup, Fed. We expect the Federal Reserve to keep interest rates for the next year or so low by all the liquidity that they're providing in bond purchases that you're doing. But ultimately, on the other side of that, most recently, we've seen the 2s and the 10s and 30s, if you will, sort of all adjust the way they should be if it's predicting a healthier economy or forecasting a healthier economy in the future. And all that means is we look for a steepening in the yield curve, which means the longer dated maturities start rising in rates, but the shorter dated maturities, again, the 2-year Treasury still stays low, if you will. So that's actually another positive setup. That's why you're seeing financials rally in the last couple of weeks, because the steepening of the yield curve. But ultimately, that indicates a recovery in the economy. So it's a very, very positive long-term bullish signal. Short-term, again, we could expect volatility. So there's some things that we're seeing and watching, but ultimately that's our report for today, and thanks for watching.